Welcome to the video, and today we're going to be talking about ETFs, which has become one of the most popular investments over the past 25 years. So I'll be going over what an ETF is, 6 of the benefits of ETFs, the best ones out there, and then I will walk you through step by step on how to invest like Warren Buffett. So stick around because what I'm about to share can make you a guaranteed millionaire.
$1 million.
For people new to the channel, my name is Jake. I'm a 30-something living in Somewhere, USA with my wife and our dogs Archie and Harper. I'm a full-time worker, a part-time personal finance dabbler, a travel enthusiast, and in the course of this video, I will be sharing some clips from Carolina Beach in North Carolina. But this isn't why you clicked on the video, so let's cannonball in. What is an ETF? The simple answer is that it is an exchange-traded fund. And if you're wondering what that means, it's that it's a fund that is exchange-traded. I'm just kidding. It's a fund that trades on the stock market like an individual stock. If you've ever traded shares of stocks, well, trading an ETF is no different because they trade the exact same way. If you've never done either, that's totally okay, and I will show you how later on. The fun part, not the fun part, what kind of the fun part? But the fun part means that it is a group of individual investments. It could be stocks, bonds, derivatives, or even real estate. A fund allows a person to invest in specific assets and securities that they may otherwise not be able to have access to. To have the same allocation as S&P 500, that would cost, well, let's just say a lot of money, because Amazon is over $2,500, but you can buy an ETF for much cheaper. Now that you know what an ETF is, let's talk about how they work. First, it is important to understand that when you buy an ETF, you're not actually buying the underlying investments in the ETF, because as we just mentioned, if we were going to do that, that just costs way too much money. For example, if you buy an S&P 500 ETF, you're buying something that tracks the movement of the S&P 500 index. You are technically buying shares of a fund company itself, not shares of the 500 companies that make up the S&P 500. I hope that makes sense. To make even simpler, you're not buying the 500 companies, you're buying something that tracks the same movements. Buying ETFs have gained popularity recently, and if you're not already buying them, then you're missing out. There are several great reasons that you would want to add an ETF to your investment portfolio. We'll discuss all the reasons in a little bit, but the primary reason is diversification. Diversification is a fancy way of saying that you don't want to only have one option. You are more likely to have success if you pick 500 companies and not just one. If you're playing basketball, you're more likely to make one shot if you have 500 attempts over just one. Unless you're me, of course.
Rain dance! Let it rain!
By spreading out your money over several investment securities like stocks, bonds, and commodities, you reduce your overall risk. Risk from what, you might ask? Well, I'll give an example. Let's say that you have $1,000 to invest and you buy a share of Tesla, and at this price, that's one share. Although Tesla has proven to be a volatile yet good investment over time, the stock will still experience fluctuations in prices, meaning it may go up one day, but then another day it may drop 15%. And if you only have that one stock in your portfolio, well, then it drops 15%.
No! God, please, no! No!
Or maybe your portfolio is made up of several companies, but they all happen to be in the technology sector. This can also be a problem because if the technology sector is down, your portfolio will take a hit because you're only investing in technology stocks. Buying ETFs can reduce the risk of your portfolios taking a beating of the day-to-day volatility of the market. Or like what we have experienced recently, we've had stocks which are down 50 to 60%, while some of the large ETFs are only down 10%. Having ETFs may provide immediate diversification because there are groups of hundreds of different investments. For example, instead of buying individual shares of Tesla, you can buy a technology stock ETF, which may have 10, 20, or even 100 stocks. To further diversify your portfolio, you can buy multiple types of ETFs. For example, instead of only buying technology ETFs, you can buy index ETFs, commodity ETFs, and other industry ETFs as well. So in the end, by investing in ETFs, you're adding hundreds of companies to your portfolio, which reduces your risk. Now let's talk about the benefits of ETFs. Many investors prefer the benefits of ETFs compared to traditional funds like mutual funds. We'll briefly go over these benefits before we go step by step over how to purchase one, and I promise we'll actually buy one. Benefit number one, diversification. One of the biggest benefits of ETFs is diversification. We touched on this earlier, but a single share of an ETF can give you broad exposure to hundreds of stocks, bonds, derivatives, and even real estate. Let's say you had a share of the popular Vanguard S&P 500 or VOO to your portfolio. You will instantly add exposure to 500 of the largest companies in the US. So what does that mean? Well, imagine owning shares of all 506 stocks that make up the S&P 500. That would require an investment of over $30,000 to mimic the movement of the S&P 500 index. The same thing could be accomplished using an ETF for a lot cheaper. Buying an S&P 500 ETF will give you the same exposure to all 506 stocks the same way it would be if you bought each stock individually. ETFs allow you to diversify your portfolio very easily without any of the work, such as picking and researching stocks. ETFs have made building a solid portfolio a lot easier. As long as you own ETFs in various asset classes and sectors, your portfolio will be very well diversified. There are ETFs available in every asset class, sector, and industry of the market. If you wanted to diversify your portfolio and add real estate or commodities, there are ETFs for that. If you own Tesla stock but wanted exposure to the entire technology sector, there is an ETF for that as well. Benefit number two is trading flexibility. ETFs are traded on the stock market throughout the day like stocks. This is unlike mutual funds and index funds, which are only traded once per day after the market closes. The ability to trade ETFs on the stock market makes managing your portfolio more efficient. If you need to quickly buy or sell shares of an ETF, you can do that. Most ETFs have trading volume throughout the day that your order will be filled instantly. Trading volume refers to the amount of shares that are being traded. The more shares being traded, the higher the volume and the easier it is to get your order filled. And this also means ETFs are highly liquid, meaning that you can convert them to cash quickly. Mutual funds and index funds aren't as liquid because it may take a couple days to sell your shares in these funds. Benefit number three is that they're low cost. Compared to other types of funds, such as mutual funds, ETFs are known to have very low costs associated with them. This cost is called the expense ratio. The expense ratio is simply the total cost of owning shares of the fund. It factors in administrative, management, advertising, and other expenses required to run the fund. For example, the popular Vanguard S&P 500 ETF, VOO, has an expense ratio of 0.03%. This is considered very low. Say you invested $1,000 into shares of this Vanguard ETF with an expense ratio of 0.03%. At the end of the year, you'd only pay 30 cents in fees. That's less than adding a side of guac at Chipotle. Costs of ETFs are low because they are passively managed. This means there isn't a management team making day-to-day decisions. It's not the case for funds such as mutual funds or hedge funds, which are actively managed. Actively managed means that there is a dedicated management team that makes investment decisions for the fund daily. This, of course, isn't free and it comes with a price, and that price is a higher expense ratio. In the case of mutual funds, expense ratios can typically range between 1 to 2%. These fees add up significantly over the years. In fact, NerdWallet analyzed a variety of investing scenarios and found that paying a 1% fee could cost you more than $590,000 over 40 years of saving. Number 4 is the tax benefits. ETFs are known as being very tax efficient, especially compared to mutual funds. And to better understand why, you have to understand capital gains tax. When you buy an investment and it goes up in price and then you sell that, you have to pay taxes on that difference. Let's say you buy a share of Apple and it goes up $20, you then sell that stock and have a $20 profit. You have to pay taxes on that $20, which is known as capital gains tax. The IRS is always watching and they want their cut. The reason ETFs are tax efficient is because they're passively managed. This means the fund isn't buying and selling investments over the course of the day, trying to beat the market to get a higher return. But what they do instead is buy investments that mimic the market, which means it holds these investments indefinitely. But how does that make them tax efficient? Let's go back to capital gains tax. A capital gain is a profit from a sale. This means the more buying and selling you do, the more capital gains you have to pay. Because ETFs aren't buying and selling, there will be less capital gains. This is different than most traditional mutual funds, which are trying to beat the market, which are trying to get in and out of positions to get a higher return. Mutual funds almost always pass these capital gains tax onto the investor, which can of course eat into your profits. The only time you're taxed on an ETF is when you sell with a profit. This is assuming that the ETF is not within a tax advantaged account like a Roth IRA. Benefit number 5 is dividends. Most ETFs will pass along dividends to you. Dividends are payments made by a company to their shareholders, which are people who own shares of those stocks. And if you're interested in the concept of this, of being paid by big companies, I have a link up above and down below to 7 of my favorite dividend stocks. When you invest in certain ETFs like the Vanguard S&P 500, you will be getting some dividends back, or if you only want to be in a dividend ETF, you can do that as well. Benefit number 6 is simplicity. Using an ETF has made investing really simple and easy. They give beginners access to greater returns, diversification, and better tax benefits, which they may not have access to otherwise. They've even made it easier to invest in a wide variety of things like stocks, bonds, commodities. Using ETFs, it's become really easy to create a well diversified and performing portfolio. Prior to ETFs, one of the only ways of doing this was through a mutual fund, and that's no longer the case. Now that we're back at my desk, let's start to talk about investing in ETFs. You can start investing in ETFs with any broker, and if you already have a brokerage account, then go ahead and use them. And if you don't have a broker account and you're looking for one, I would recommend either Public or M1 Finance, because if you use the link down below, then you can get a free stock. But if you're specifically looking to only do ETFs, you can use M1 Finance if you're completely new to the stock market and would like a more hands-on approach to setting up your portfolio. M1 Finance also has expert pre-built portfolios that you can invest in and get the same kind of returns as billion-dollar hedge funds. This is not financial advice and is only for entertainment purposes only. Some of the best ETFs to use when you are a beginner are the Spider S&P 500 ETF with ticker symbol SPY, the Vanguard S&P 500 ETF with ticker symbol VOO, the iShares Core S&P Total US Stock Market, ticker symbol ITOT, Vanguard Small Cap ETF, ticker symbol VB, Schwab US Large Cap Growth ETF, SCHG. All right, so what we have here is the homepage of M1, which I I'm going to be transparent. I am new to M1 Finance, but doing my research with this video, I have found out they would be a great place to begin. If you're new to the page, you can come up to where it says get started. I just completed this sign up process, and it's pretty standard where they will ask for your name, your address, your social security number, your salary, your experience level. That's all pretty customary because they just want to be able to identify who you are and to make sure that you're paying your taxes. As I mentioned, the IRS is always watching. Now we've logged in, we can complete the process. You do have the option of getting a sign-up bonus, which is great, or if you want to use that in addition to also getting a free stock, then you can use my link down in the description. And then if you want the bonus, then you can do that, but that would just depend on how much you are going to deposit into your account. So we can check out of here. And as I mentioned, I am new to M1 Finance, but I do think that they are a great product, and that's why I wanted to be able to share this with you. So from here, you could see what my portfolio is. I don't have any. You could see that I have the activity. As I mentioned, I am new to the platform, so we are going to try to invest at this point. We are going to look at the security options, which is another fancy word for stocks or things like that. So we're going to choose the securities. And when you're here, what's great is that if you want to create your own pie, so let's say that you wanted it to be 25% Tesla, 25% to be Google, 50% to be an ETF. You can make your own pie and then choose to invest in that every time you want to, and to have that same allocation. And so one of the things what I was mentioning too is that if you want to be able to invest like Warren Buffett, you can go to the expert pies and you can go to the hedge fund followers, and you can go to Berkshire Hathaway and get the same kind of allocation that they have there. And you can look at the performance, and this would be the dividend yield, the amount of holdings. You can see what their return is over the past 5 years, or if you want to change to 1 year, then you can see that, which is great to be up 24% when everything else may be tanking. They also have the risk level, so you can then evaluate what risk you want to be into each of these pies. And if you want to also look at different kinds of stocks, you can do that by going up to the stock tab, which is right here, and cruising through. And each of them, if you want to choose each of the sectors, you can do that. Or if you want to be able to search, then you can come up to this area right here. And overall, I think it's really easy to be able to use. And the next process is going to be to actually buy one of these. And these are some of the funds which I had talked to you about. And I would say that probably most of my holdings are in the VOO, and that's what I'm going to buy today. The reason I want to do that right now is because today is March 8th, I believe, and the stock market got a terrible tumble yesterday, so I'm just trying to buy in lower than it was previously. You don't have to time the market. You are able to dollar cost average in, but let's say that we wanted to buy VOO, so we can just tap on the name right here, go down to add, and so now we're making up our own portfolio. Let's say that we want this to be the case, and let's do the save button. We now have, so this is the portfolio, so these would be these slices in here, and if I want to be able to change those, as I mentioned, you could have this be 100%, or if you wanted to add other things at that point. So we're going to choose to come over. We want to be able to buy this ETF, so we'll tap on the buy button, and then you can enter in how much you want to be able to purchase at this time. Currently, the value is $385 per share, so I'm going to try to buy 2 of those. That math would be, so 385 times 2 is 71, just in case there's like a rounding error. So I'm going to tap continue. So it says when would I like to purchase, so that's when the market is open. So I'm going to set to say confirm the buy. It has been submitted, And now at this point, you can see that the buying power has been reduced. I have made that purchase at that point. And what else is great is that if you want to be able to get the latest news, then you can do that as well. I can look at my portfolio here to get the different kinds of the allocations. And with the upcoming trades I have that I have one buy that's in progress, if I want to view the details, that I can see that right here. So I hope this process was super easy and that it's not as intimidating as you may think. Thanks so much for watching, and I hope you guys have a better idea of how to invest like a billionaire. And if you know someone that can benefit from this information, then consider sharing this with them. And if you want to help me grow the channel, then tap that like button. And if you want to be around for when I post my next video, do not forget to subscribe and turn on the notification bell. But I will see you guys next time.